Empire Earnings. Build your financial empire.
The culmination of a working life inevitably arrives at a final outcome, either a comfortable, secure retirement or an ongoing struggle to make ends meet. Reaching that secure endpoint does not rely on a lucky streak or a sudden windfall in your final working years. The result is an extended mathematical function. It scales up from the behavioral habits and beliefs established through your very first early childhood experiences with money. To secure a positive end state, personal finance cannot be treated as a random series of independent goals. It must be mapped as a deterministic model, driven by three dynamic variables. This three-dimensional coordinate system plots those exact variables: income, age, and outlook. Their continuous interaction turns static investment milestones into shifting, moving targets over a lifetime. As it runs, the model remains highly vulnerable to external, unpredictable shocks that force the trajectory off course. While the system is volatile, a clear understanding of its mechanics allows you to initialize successful wealth management no matter where you currently sit on the timeline. Understanding the interplay between age, income, and outlook provides the structural foundation required to insulate a financial state against sudden disruption. The entire mechanism initializes in early childhood. It relies on a single behavioral axiom: delayed gratification. Early interactions with piggy banks and allowances train our initial resource allocation algorithms. You learn to hold resources to afford a desired output. As you approach adulthood, this behavioral loop scales up to handle massive incoming data streams. The adult environment aggressively tests this algorithm with the societal pressure to take on thousands in student loans or to finance a vehicle. Without delayed gratification firmly installed in youth, the heavier structural demands of adulthood will collapse the financial architecture under the weight of early debt. We track the model's performance starting with variable 1, income. Because you cannot invest zero capital, income acts as the entry point for the entire system. A first career job delivers a systemic shock, requiring immediate division of capital into high-stakes pathways like a 401k. This creates tension. The new capital flow encounters friction, like overpriced rentals and car payments, fighting against the requirement for delayed gratification. Many encounter a psychological blind spot, forgetting that parental safety nets are no longer in place to absorb the monthly credit card bill. Income functions as the raw fuel. It either efficiently powers the wealth generation engine, or it burns out entirely inside these lifestyle traps. Variable 2 is age. This serves as the temporal timeline upon which the entire model operates. Financial planning relies on three standard demographic segments: young, middle-aged, and old. But these chronological classifications almost always miss their mark. The system routinely experiences phase misalignment, where physical calendar age completely desyncs from actual financial maturity. You frequently find middle-aged adults looking at investments for the very first time, operating with the financial constraints and beginner strategies of a 20-year-old. Conversely, older individuals who lacked discipline in their youth are often forced into rigorous, restrictive beginner-level budgeting well past their prime earning years. Relying on your birth year for goal setting obscures the truth. Real financial strategy requires a brutally honest assessment of your actual systemic phase, not the calendar year. Variable 3 is outlook. This maps the environmental playing field, constructed by a lifetime of structural choices. Family planning decisions shift the underlying calculations, including the number of children and required wage earners. Career expectations dovetail into this. A highly educated path ramps into increased earnings, while others stagnate in dead-end jobs, requiring forced cutbacks. Even if income, age, and outlook are perfectly aligned, the model constantly faces systemic perturbations. Carefully laid plans hit roadblocks like layoffs, health issues, and the heavy burden of caring for aging parents. Ignoring the requirement to save for a rainy day leaves a gap in the model. Without a realistic 401k allocation, the system remains exposed to external shocks. Outlook ultimately dictates the system's resilience. Without a meticulously maintained financial buffer, a single perturbation can trigger a total collapse of the wealth timeline. Many individuals face late-stage initialization. You may reach your 40s before realizing that the timeline is moving much faster than anticipated. Attempting to set complex retirement goals this late in the sequence naturally invites a heavy dose of fear. However, this fear serves a highly functional utility in the model, provided you convert it instantly into intense wealth management urgency. This intense urgency allows a late starter to aggressively allocate capital and compensate for decades of missed time. The wealth system is highly sensitive to early starts, but you can jumpstart the mechanism at any time by transmuting fear into disciplined, high-speed action. The wealth system is bound by a simple constraint. It cannot operate on zero. Regardless of your age bracket, your income level, or your complex outlook, the entire model hinges on the action of setting aside the very first dollar. On the timeline, the slow, steady compounding of an early start mathematically dwarfs the frantic urgency of a late start. This is the decade's advantage. Long-term compounding takes the basic childhood habit of delayed gratification and scales it into an autonomous, self-sustaining wealth generator. Sustaining that early discipline is what actually produces the resulting wealth, allowing you to finally enjoy the output of your saving habits. A comfortable retirement is not an accident of fate. It is the result of a single behavioral algorithm, maintained and adjusted against the variables and chaos of a working life.
Operating financially day by day, what we call the hand-to-mouth approach, creates a highly volatile state. Without an overarching structure, resource allocation becomes purely reactive. Money flows out as fast as it comes in to meet immediate pressures, leaving nothing to compound over time. To generate lasting wealth, that reactive chaos must be replaced with a rigid structure, an investment goals workflow. Think of this workflow as a grid dropping over the noise. It captures scattered financial decisions, forcing them into a directed vector. This behavioral framework enforces discipline and holds you accountable to long-term priorities, rather than a complex mathematical formula. We will construct this system from the ground up. We start by anchoring its psychological foundations, then move to building out its practical execution engine. Abstract desires alone do not generate returns. A systemic architecture is the absolute prerequisite for converting what you want out of life into measurable, compounding wealth. Building this architecture requires starting below the surface. Before a single dollar is allocated, we have to construct the psychological base layer that addresses three major themes of money management. The first load-bearing pillar is the life plan intersection. The system must lock directly into the future you intend to build. Engaging your thought process with long-range objectives forces a cognitive shift. It pushes out the desire for immediate gratification by requiring you to define the sacrifices needed today to secure that distant horizon. The second pillar is the generation of an accountability loop. Mechanically, this means establishing a schedule to review your progress. When the numbers slip, the schedule forces you to confront the data and invoke the discipline required to get back on track. The final pillar is motivation impact. Seeing tangible progress against your goals yields returns well outside your portfolio. It lowers anxiety and actively improves both your physical health and overall mental outlook. These three pillars combined create the necessary psychological constraints required to support the harsh mathematical realities of the next layer up. With the base secured, we move to the operational processing layer. The Australian Investors Association recommends a filtering mechanism known as the SMART format. This operates as a strict algorithm to process your goals. Abstract desires enter the top. The specific and measurable layers shear off the ambiguity, demanding absolute clarity and strict quantifiable thresholds for achievement. Next, the achievable and relevant filters test the goal for practical viability. They ask if the target requires practical action and if it realistically aligns with your actual life circumstances. Finally, the time-based filter attaches a deadline, providing the necessary tracking mechanism to measure your velocity over time. Running a goal through this exact algorithm forces you to quantify the budget cuts and lifestyle choices required to hit that target. Before execution begins, the finalized action plan faces a brutal reality check. Your meticulously formatted goals must now be weighed against how you have historically handled money and the true capacity of your current or expected earnings power. If the demands of the action plan are outlandish and completely outweigh your economic reality, the structural integrity of the entire system fails. The protocol here is merciless. If the plan doesn't match reality, throw it away and start over. You must concentrate on baby steps rather than broad-brush daydreams. Operating this filtering algorithm is mandatory. It prevents catastrophic behavioral failure caused by committing to statistically impossible targets. We have the structural design. Now we move to physical initialization. This is the execution engine of the workflow, the precise point where capital enters the system. Those baby steps represent the minimal initial input required to power up the infrastructure. As this graph illustrates, a small 401k contribution, especially when combined with an employer match, is entirely sufficient to get an infant system online and begin plotting a compounding curve. Financial advisors often recommend allocating the maximum allowed by law. While mathematically optimal, that advice ignores practical reality. Demanding a maximum allocation introduces immediate systemic friction. For most young professionals just starting out, maxing out an account is simply impossible. This demographic faces an enormous operational constraint, the heavy drag of student loan debt incurred by people born after 1990. An early-stage investment system must be deliberately calibrated to pull against this specific debt friction without breaking down. Launching a small, fully functional system that respects your actual debt constraints is vastly superior to designing a theoretically perfect portfolio that you can never afford to switch on. Once the engine is running and generating wealth, the operator's role shifts to maintenance. Your monthly and quarterly statements act as vital feedback mechanisms. They tell you exactly how the system is performing against your designated targets. This data lets you make continuous micro-adjustments as your money flow changes. The protocol demands small corrections, avoiding massive overhauls. You will also encounter market friction. Negative returns and periods of red ink are mathematically inevitable. These downturns are not system failures. They are necessary stress tests, designed to build operator patience. Analyzing the red ink forces you to re-examine your own decision-making process, ultimately hardening your behavioral system against emotional panic. Over time, the need for intervention drops away. The ultimate end state is a fully actualized system, self-assembling and compounding wealth automatically in the background. An optimized investment goals workflow takes the daily, hand-to-mouth anxiety out of personal finance, replacing it with an automated, resilient engine for lifelong security. In structural engineering, forcing a single, isolated pillar to bear the entire weight of a complex load guarantees a catastrophic collapse. Yet, this is exactly how most people structure their personal finances. They attempt to fund every milestone across the human lifespan from a single, undifferentiated pool of capital. This timeline maps out the major high-cost events of a standard human lifespan. We plot specific, heavy financial loads: purchasing a home, raising children, and ultimately funding decades of retirement. When a single, unsegmented pool of capital is stretched simultaneously to satisfy all these nodes, the system breaks down. Drawing on the same funds for immediate needs and future decades rapidly triggers liquidity warnings and early withdrawal penalties. The system fractures because the liquidity of the assets does not match the temporal timing of the life milestones. Capital timing presents a strict paradox. Wait too long to deploy your assets into the market, and you sacrifice the mathematics of compounding yield. Access that same capital too early, and you incur heavy statutory penalties, or are forced to liquidate positions at a steep loss. This diagram outlines the solution: strict temporal asset allocation. We divide the lifespan timeline into 3 distinct color-coded zones: short-term, intermediate-term, and long-term. By doing this, we break broad investment goals into defined timeframes, directly matching specific account types to natural life stages. Every statutory account vehicle is rigidly matched to a precise human need. This systematic approach isolates liabilities, actively preventing the systemic financial failure seen in unsegmented, single-pool portfolios. Temporal constraints dictate the architecture of a resilient lifecycle portfolio. Capital volume alone cannot ensure structural integrity. This zoomed-in diagram isolates the first operational phase of the lifecycle architecture, the liquidity layer, operating across the short and intermediate zones. Bank and brokerage accounts are explicitly mapped here, offering maximum liquidity. Capital flows in and out of these nodes with zero statutory friction. This high liquidity allows you to rapidly deploy cash for immediate SMART goals: securing a home, purchasing an automobile, or meeting pressing family obligations. Because these targets are imminent, they require frequent savings progress reviews to ensure short-term goals remain properly funded and on schedule. Moving slightly further out, intermediate planning captures a more generalized pool of capital, set aside for inevitable mid-range events. The defining feature of this entire layer is fluid accessibility. The funds must be ready to move on demand, a requirement completely at odds with the strict inflexibility of retirement models. High liquidity accounts serve strictly as the operational cash flow mechanism for immediate life stages. They are not wealth-building engines. This vertical barrier illustrates a critical allocation within the intermediate planning phase, the emergency fund. Mathematically, this capital functions as a rigid structural firewall that deflects chaotic financial variables away from the core portfolio. Its primary function isolates your wealth completely from the intense volatility of sudden, unforeseen life surprises. By absorbing these localized shocks, this firewall explicitly protects the primary retirement core, ensuring you are never forced to make premature early withdrawals. Long-term capital requires decades of entirely untouched incubation to fulfill its compounding purpose. A well-funded firewall absorbs the immediate damage, allowing those long-term accounts to safely endure broad market risk without manual interference. The emergency fund's systemic value is the preservation of the long-term compounding engine. Its utility in solving short-term crises is secondary to this structural protection. Past the firewall, this diagram maps the most structurally restricted segment of the wealth architecture, the long-term zone, holding IRA and SEP nodes.
The absolute rule is no premature access. A rigid boundary actively blocks outward flow. This architecture is enforced by statute. Stiff penalties are deliberately coded into the tax system to deter early withdrawal, heavily taxing any capital that forcefully breaches the barrier. IRA and SEP accounts are exclusively mapped to the post-employment temporal phase. The sole exception to this absolute rule is a truly dire circumstance, offering absolutely no viable alternative for necessary capital. Extracting these funds early severely truncates the mathematical growth curve of the portfolio, permanently destroying the future compound interest that money was expected to generate. This highly restricted access protocol contrasts sharply with the fluid, frictionless liquidity layer established for your short-term needs. The penalty zone enforces temporal discipline. It legally and mathematically binds capital to the long-term timeline. Many investors reach middle age before engaging with this planning, but starting later carries the benefit of experience. You can accurately gauge your future earnings power by examining an established household career trajectory. High-wage earners can purposefully leverage these established career trajectories to aggressively accelerate wealth building, executing a rapid catch-up phase. Conversely, if income has stagnated, forcing the necessary catch-up savings requires aggressive lifestyle changes until income structurally exceeds expenses. This split-screen mathematical model illustrates the imperative of middle-age planning. Compounding debt curves, running at 18 to 25%, rapidly overtake and crush standard investment return curves mapped at 10%. Standard equity returns are mathematically negated by carrying high-interest credit balances. It makes zero sense to earn 5 to 10% annually while credit cards actively drain your net worth. Eradicating high-yield debt takes absolute precedence over standard equity accumulation. The debt curve must be eliminated to allow the investment curve to rise unimpeded. This requires sacrificing standard expenditures to aggressively clear liabilities until the household's income strictly exceeds its total operational expenses. Negative yield from debt is a structural leak. It renders wealth accumulation mathematically impossible, regardless of your investment choices. As the timeline reaches the terminal phase past age 70, the portfolio's momentum must continue. It is a dangerous error to assume wealth building simply ceases. Financial burdens routinely escalate in the terminal phase, driven by rising, unavoidable healthcare and dependency costs. Entering retirement entirely dependent on baseline government checks carries high systemic risk, creating well-founded anxiety over basic household solvency. This diagram highlights a major statutory complication in the terminal phase: required minimum distributions, or RMDs, operating as a forced outflow valve drawing capital away from standard retirement notes. Government rules legally force investors to begin withdrawing funds from non-Roth retirement accounts starting exactly at age 70 and a half.
When modern, increasing life expectancies intersect with this forced withdrawal rate, the portfolio faces a severe mathematical threat of early depletion. Active wealth building and strict investment planning must continue right up to death to counter these dual pressures. Continuous compounding remains a specific necessity if a surviving spouse will rely entirely on the remaining funds to cover their own ongoing expenses. By strictly architecting wealth across defined temporal timeframes, from early liquidity layers to statutory post-70 distributions, capital is protected from penalties, optimized for yield, and permanently insulated against systemic lifecycle failure. Standard financial planning relies on a specific mathematical heuristic. Retirees must replace 70 to 85% of pre-retirement income to maintain their lifestyle. Some advisors push this target even further, advocating for a 100% replacement rate to ensure retirees have the capital needed for travel, new hobbies, or discretionary spending. This chart translates targets into milestones, plotting age against capital accumulation to lock in an 85% goal. But these standard models are incredibly brittle, relying on theoretical economic assumptions that fail to account for a modern lifespan's actual volatility. We can see these axioms breaking in real time. There has been a massive surge in baby boomers remaining in the workforce past age 65, often accepting significant pay cuts because their initial savings models failed to materialize. To understand the failure of these models, we have to stress test them against three specific constraints: delayed investment starts, inelastic late-stage consumption, and systemic demographic deficits. When we treat retirement as a uniform multiplier, we overlook the specific variables that determine whether an individual can actually maintain solvency in their final years. We'll begin with the industry's most common baseline, the milestone framework developed by Fidelity Investments. This chart plots the required accumulation at specific life stages, securing 1 times your pre-retirement income by age 30 and 3 times that amount by age 40. As the timeline extends, the curve steepens. The model requires 7 times your income by age 55, eventually reaching a terminal target of 10 times your income at age 67. In concrete terms, a retiree projecting an annual need of $100,000 must have exactly $1 million in savings by the time they reach age 67. This math relies on a hidden requirement. The individual must maintain a rigorous 15% annual savings rate throughout their entire working life. Furthermore, the model assumes this 15% allocation begins exactly at age 25, allowing for decades of uninterrupted compounding. Finally, more than half of those early savings must be continually allocated to equities to achieve the necessary growth. This model assumes a level of disposable income that many 25-year-olds simply do not have, as entry-level salaries are often diverted to student loan commitments and unpaid internships. These early-stage debt obligations functionally prevent young professionals from hitting that 15% target during their most critical years for compound growth. This delay triggers a mathematical penalty. Missing the age 25 start date causes the required accumulation line to steepen aggressively, requiring a much higher annual commitment later in life to reach the same $1 million target. Standard accumulation models inherently fail because they assume a frictionless early career economy that no longer exists for modern graduates. Beyond the struggle to accumulate capital, we must examine how that capital is actually consumed during the terminal phase of life. The Employee Benefit Research Institute provides a data-driven look at this through their Consumption Activities and Mail Survey, which tracks actual spending habits for seniors over 70. The data directly challenges the long-held assumption that most retirement savings go toward discretionary lifestyle choices, expensive travel, and leisure. As this chart shows, housing costs dictate the baseline of retirement spending, regardless of income level. This expense is remarkably inelastic. Housing consumes 31 to 36% of total capital across every senior age bracket, remaining rigid as other spending fluctuates. To this baseline, we must add the second major constraint on late-stage capital, healthcare. Healthcare costs often start small, making up only about 7% of total spending for those at age 45. However, these costs accelerate exponentially. By age 75, healthcare spending more than doubles to 15.5%, taking up a significantly larger portion of the available budget. Together, these two categories demonstrate a sobering reality.
More than 50% of retirement dollars are spent simply on housing and staying alive. Meeting these essential survival requirements becomes an impossible task for retirees who are limited to a fixed monthly Social Security check. Because over half of retirement spending is dedicated to inelastic costs, base capital requirements must be structurally scaled up to account for medical inflation. The final variable we must consider is demographic. Retirement solvency is heavily influenced by gender. A 2016 study by Aon Hewitt highlights the structural disparity between how men and women accumulate retirement savings. The findings show a significant gap. 83% of U.S. women are failing to save enough for retirement, compared to 74% of men. This gap changes the required multiplier. While men need about 10.6 times their final income, women require 11.5 times to maintain solvency. This higher requirement is primarily due to longer life expectancies, meaning women's savings must sustain them for more years. Interestingly, the deficit is not caused by a lack of participation. Both men and women participate in 401k plans at the exact same rate of 79%. The disparity lies in the contribution amounts. Women set aside an average of 7.5% of their salary, while men allocate 8.7%. This contribution gap is further worsened by lower average earning power for women across the workforce. The compounding effect of these differences is stark. In 2015, average 401k balances for women were just over $71,000, only 59% of the $119,000 average held by men. A universal retirement multiplier is structurally inadequate because it ignores the mathematical penalties inherently placed on women in the current economy. The data suggests we must move away from the static 70 to 85% replacement ratio. It is no longer a reliable economic tool. The Fidelity 10x curve serves as a useful benchmark, but its assumptions of frictionless entry into the workforce are increasingly obsolete. Offsetting these deficits requires structural changes. To bridge the gap, projections show that women may need to extend their working lives to age 69 just to reach the same level of solvency as their male counterparts. As long as the workplace gender pay gap persists, demographic-specific modeling is a mathematical necessity for achieving solvency. True late-stage solvency is not achieved through a standardized multiplier, but by rigorously modeling for specific, individualized economic friction.
Over multi-decade timelines, long-term equity returns consistently demonstrate reliable growth. Yet, despite this historical trajectory, millions of individual investors fail to reach their baseline objectives. We frequently misattribute this failure to picking the wrong stocks or starting with too little capital. The true vulnerability has very little to do with market mechanics. The failure point is the investor's own behavioral psychology. A mathematically sound investment plan is entirely useless if the human executing it lacks structural discipline. A massive divergence exists between individuals who rely on pure willpower and those who actively engineer their behavior. Achieving financial success is not primarily an exercise in market analysis. It is an ongoing battle of behavioral mechanics against internal and external friction. Human behavior in financial planning is highly predictable, and we can break it down into measurable success rates. This diagram visualizes the foundational split in investor outcomes. Relying on internal willpower alone results in a 35% success rate, but utilizing behavioral interventions achieves a massive leap to greater than 70%. This data delta reveals a gap that is impossible to ignore. That gap represents the difference between relying on internal willpower and deploying an external system that doubles the statistical probability of success. To understand how to achieve this jump, we must deconstruct the exact behavioral tools that double those success rates. We also must examine the unpredictable, catastrophic real-world forces that threaten to dismantle those very tools. Closing the gap between the 35% and 70% success brackets is the single most critical objective for a financial planner. The academic foundation for this behavioral divide comes from a 2015 study by Dr. Gail Matthews at Dominican University. This chart shows the controlled behavioral model. The left side illustrates the control group, participants who kept their goals internalized to themselves, representing the baseline 35% success rate. The active behavioral intervention required a physical action. Participants wrote down their goals in detail.
The crucial second step required establishing a third-party reporting loop, where individuals sent regular progress updates to their peers. The statistical result is clear. This combined externalized commitment device pushed the group into the greater than 70% success bracket. The study tracked these results across a broad age range, from 23 to 72. This age diversity proves it is never too late to achieve realistic investment goals. These external commitment mechanisms directly compensate for inherent human deficits in discipline and willpower. Financial discipline is not an inherent personality trait. It is a mechanical system that can be deployed at any age to force follow-through. The vulnerability of the controlled behavioral model is that these commitment devices assume life exists in a vacuum. They are completely susceptible to exogenous shocks, unpredictable, severe disruptions that originate outside the financial markets but hit the individual directly. These localized friction points include unexpected job loss, sudden sickness, divorce, or systemic discrimination. The immediate mechanical consequence of these shocks is a severe degradation of an individual's earnings and savings power. This triggers a profound psychological shift. The investor is forced out of a wealth-building mindset and plunged into short-term survival mode. When life throws these hardballs, even the most disciplined, goal-writing individual will find it incredibly difficult to stay on financial track. The third-party reporting loop breaks down rapidly when an individual feels the shame or panic associated with a localized financial crisis. A perfectly engineered behavioral system is only as strong as its contingency plan for sudden, catastrophic personal loss. The variables extend beyond personal localized shocks to systemic global market volatility. Bear markets and crashes are an inevitable reality over the decades between an investor's first contribution and retirement age. The catastrophic 2007 and 2008 financial crisis serves as the ultimate historical example of this systemic friction. The scale of the damage was massive. American investors lost trillions of dollars in their retirement accounts during this period. Overwhelmed by panic, investors frequently experience a behavioral collapse, ignoring sound advice and empirical data. This graph illustrates the realized risk tolerance gap. While the dotted line shows a confident, stated risk tolerance, the solid line representing actual behavior drops sharply as it enters a red-shaded bear market zone. Investors consistently overestimate their ability to stomach volatile periods. The consequence of this gap is that individuals abandon their long-term positions, dumping them at bargain basement prices. Cautionary: it is easy to claim you will stand firm, but you cannot accurately forecast your own bravery until the crisis actually happens. Systemic market crashes do not merely destroy portfolio value, they actively destroy the investor's cognitive discipline. Merging commitment devices with exogenous variables shows the rigid structure acting as a solid beam, absorbing the chaotic lightning bolts of systemic volatility. We cannot control the timing of a bear market. The only controllable metric is our behavioral buffer's structural strength.
The Matthews framework of written goals and reporting functions as an emergency braking system against panic. A strict third-party reporting loop creates intentional social friction. It forces an investor to justify an irrational panic sell to a planner before executing the trade. An accurate, rigorously stress-tested understanding of your real risk tolerance must be mapped out on paper before a crisis hits. Writing down specific parameters for crisis management prevents the buy high, sell low reaction from taking over during emotional peaks. While long-term equity returns are highly probable, surviving the journey to collect them requires going the extra mile in self-regulation. Success demands externalizing our commitments to bridge the gap between our stated intentions and our realized behavior. True financial discipline is not a static human trait you are born with. It is an engineered system designed specifically to survive the inevitability of chaos.
A single individual operating in the modern economy faces a hard mathematical ceiling. Income generation, savings velocity, and credit capacity are strictly bound by the output of one person. When a second income stream is introduced to the household, that constraint is broken. The resulting economic unit suddenly has access to expanded capital capacity. By pooling resources, the household can generate surplus liquidity faster than two individuals operating separately. Yet, despite this mathematical advantage, the dual-income household frequently breaks down. This bar chart visualizes major predictors of divorce based on research by Sonia Britt at Kansas State University. Notice the dominant statistical outlier on the far right. arguments about money outpace every other behavioral factor as the top predictor of a relationship ending. A breakup later in life destroys the capital efficiency the unit built. The fracturing of pooled assets carries financial consequences that are extremely difficult to recover from. Setting intermediate and long-term investment goals together requires a deep level of trust. Both partners have to rely on each other to maintain the integrity of the system. But simply pooling money is not enough. The daily financial decisions of both individuals must remain tightly synchronized. A merged financial system maximizes capital efficiency, but without strict behavioral alignment, it introduces fatal structural vulnerabilities into the household. To map exactly how this dual-node system creates an advantage, we can apply a household cash flow model. This Sankey diagram illustrates the flow of a dual-income household. Adding a second income stream removes the primary bottleneck in intermediate-term planning. With two incomes continuously feeding the central pool, saving for a down payment and qualifying for a mortgage becomes structurally easier to accomplish. We see the value of this shared pool most clearly when assessing the specific vulnerabilities of the 45 and up demographic. For this age group, housing requires large, inflexible capital outlays: rent, mortgage payments, insurance, property taxes, and ongoing maintenance. Between 31 and 36% of total retirement income is consumed entirely by these fixed costs. But when pooled income is applied to these exact same fixed costs, we observe a mathematical principle called structural dilution. Because the absolute cost of the housing remains static, the multi-person household reduces the percentage burden placed on each individual. This dilution generates immediate savings, freeing up capital that can be redirected into other investment outlays. Diluting fixed living costs through shared allocation is the primary mathematical defense against financial strain in later life. Those mathematical advantages only hold if the system remains aligned. The primary threat to the household is self-inflicted behavioral friction. We can define this variable as uncoordinated parallel consumption. Look at this comparative model of a household ledger. On the left side, Node A represents compliant, mathematically sound action. Node A diligently allocates a strict portion of their weekly income directly into savings to systematically build capital. But economic units are vulnerable to asymmetric action from the second partner. On the right side, Node B is aggressively expanding a credit liability gauge to its maximum limit. By tapping out credit card limits, Node B introduces high-interest debt that requires immediate and continuous servicing. Within the shared liquidity pool of the household, these opposing actions collide. When financial goals lack agreement and coordination, the progress made by one partner is consumed by the liabilities generated by the other. This behavioral divergence generates a roadblock to long-term prosperity, negating the structural efficiencies gained by merging two incomes. Beyond self-inflicted friction, the dual-node system must also survive exogenous, external shocks. A prime example is the physical disparity that eventually develops between aging partners. A major illness or the sudden requirement for institutional care introduces a large, unplanned capital drain on the household. Standard safety nets let rigid limitations and coverage ceilings that leave individuals responsible for the overflow. This graph models the trajectory of extended medical care. Once the healthcare cost breaks through the Medicare limit, there is an immediate, aggressive drawdown on the household's secondary liquidity pool. If the unit has not engaged in intermediate-term planning, absorbing this shock creates severe financial hardship for the healthy partner. Waiting too long to prepare for these exact complications makes them difficult and often mathematically impossible to overcome later in life. Establishing clear investment goals as early in life as possible is the only way to build the capacity to absorb these hits. Surviving late-stage systemic shocks requires a pre-planned, coordinated capital reserve that functions separately from basic retirement allocations. The operational solution to both behavioral overwhelm and external systemic risk is a process called staged capital sequencing. Executing this process requires a level of discipline and a commitment to major life changes that makes many people uncomfortable. This diagram outlines the sequence. Step 1 mitigates the feeling of being overwhelmed by starting small. It begins with securing minimum 401k contributions. Watching a small nest egg grow quickly through compounding generates the initial momentum necessary for the partners to stay aligned. Step 2 requires escalation. The household must raise those contributions to the maximum legal threshold as soon as their shared cash flow permits. Step 3 moves up the staircase to address the remaining disposable income accumulating in standard checking and savings accounts. This surplus is actively allocated into realistic, tightly coordinated short and intermediate term investment goals. Managing a dual-node economic unit is a lifetime pursuit. It demands careful, continuous planning at every stage of the relationship. While household economics carries a high statistical risk of behavioral failure, synchronized execution of this sequenced model provides a reliable path to long-term prosperity.